Alright, so hi guys. The market is finally starting to pull back as we anticipated in my last video. So if you recall my last video, I said that there's a high chance that the bear market has made its low back on June 16. And the reason was because the market, ever since declining 20%, going to a bear market, it has retraced 50% of the decline. If you have not watched it, watch my last video. And I said when that has happened historically to the S&P 500 since 1957, usually the market has made its low for the bear market, unlikely for the low to be revisited. Now, it doesn't mean that it can't, it's just unlikely, unless the Fed gets more aggressive and starts to raise rates a lot more than anticipated, which is the market is anticipating another 100 basis point raise for the end of the year. So it all depends on the September, November, and December meeting. At the same time, this recent rally, call it a bear market rally, call it a potential new bull market rally, whatever you may call it, we don't know until after the fact, right? But so far, this rally has caused 90% of the stocks in the S&P 500 to trade above its 50-day moving average. And historically, this has been a potential bull market signal. Because if you look at past bear market rallies, usually not all the stocks participate in the rally. You don't have that market breadth. But in this case, we have got the breadth. So there is a high chance that this could be the start of a new bull market. But as I said in my last video, we don't expect the market to go up in a straight line. I do expect the market to make all-time highs by the end of the year or by next year. But again, it's not going to go up in a straight line. It's going to move in wave patterns. And I said that this area is going to be a potential area of resistance because of this trendline resistance and the 200 moving average. And sure enough, like magic, the market hit that 200 moving average and is now starting to pull back down. So we are going through what we call a pullback right now. So how deep will this pullback be? Are we gonna just pull back slightly and then break above that resistance? Is it going to pull back all the way down to this level, which is a potential area of support, and then it's going to rally back? Or could it pull back all the way down to, this area over here? Could it even almost retest this low? No one knows. No one has a crystal ball how deep this pullback will go. Again, it all depends on what the Fed does during the September, October, and December meetings. If they stick with the plan, which is to just raise interest rates by another 1%, then unlikely we're going to make a deep pullback. We may just make like a shallow pullback and then we go back higher next year. But if the Fed says, you know what, inflation is coming up again, we have to raise rates more aggressively by another 75 basis points in September, 75, then yep, the market could go all the way back down again. It could even retest those lows, right? Like I said, that's unlikely, but you never know. Anything could happen in the markets. So as an investor, now if you're invested in good companies or you've just bought the index, should you be concerned about this pullback? No, not at all. Why? Because again, as an investor, you're looking at the long term. You're looking at 2, 3, 5 years from now. And if you bought good companies, you buy the index, it doesn't matter how deep the short-term pullback is. So whether it's like a shallow pullback goes up, or it's a medium pullback goes up, or it's a deeper pullback goes up, it doesn't matter, right? Because eventually you own good companies, it's going to go up anyway. And in fact, as an investor, the deeper the pullback, the more chance you have to get more shares in to own a bigger stake in the companies that you love in order to grow your wealth even more in the long run. So in other words, as an investor, in a way, you're hoping for a bigger pullback, right? To have a chance to get back in again. Now, that's from an investment perspective. Now, on the other hand, as the market is pulling back, could we also make some extra money while the market pulls back? The answer is yes, right? So as you guys know, I'm an investor. I hold good companies and I know they're going to go up over time, okay? But in the short term, when they do pull back, instead of just sucking my thumb, I'm thinking, how could I make some extra money while it's pulling back? And the way I do it is by using options, by shorting the market in the short term by using options. So I'm going to show you all the different ways I use options and how I'm shorting this market during this short-term pullback. Now, some people ask me, Adam, why do you use options to short the market? Why don't you just short the market directly or short the S&P futures? Yes, you could do that. But the danger with shorting the market directly is that when you short the market, you are exposed to unlimited risk of loss if the market shoots up suddenly, right? And you never know. You know, if you short the market and the market goes boom, right, you get your face ripped off. But you're thinking, hey, I could put a stop loss, right? If I put a stop loss and the market goes up, it stops me out, it limits my loss. Yeah, but the danger is sometimes the market could gap up, all right? So sometimes what happens is that you short the market over here, right? You go short and you put a stop loss at the previous high, and then something happens, the market gaps up, boom, gaps up above your stop loss, you could lose a lot of money as well. And that's why when it comes to shorting the market, I like to use options, because with option strategies, you can limit your losses if the market goes in the opposite direction. So what are the different option strategies that I can use? Well, the first strategy is to buy put option spreads on the SPY or the SPX or the S&P futures. And the second strategy is to buy bull call spreads on the Vix or the Volatility Index. So I'm going to show you how I do it here. So let's begin with looking at the SPY. That's the simplest, right? Okay, so right now, if you anticipate that, hey, the SPY is going to pull back down, all right, you can use a bear put spread strategy. Now, some of you are thinking, why don't I just buy a put option? Yeah, you can do that. A lot of people, they just buy a put option, right? When you buy a put option, market goes down, you make money. But the trouble is buying a straight put option or a call option is very expensive, right? The premium is pretty high. And every day that passes, you're losing time value. So instead, I like to use a put spread. So essentially, a put spread means that I'm gonna buy a put option. Let me just write it down here, step by step, so you get it, right? So first thing is I'm gonna buy a put option, right at the current market price or slightly below the market price. We call that out of the money, right? So slightly out of the money, I buy a put option. And at the same time, I'm gonna sell a put option at my target price. So for example, if I anticipate that the market is gonna pull back all the way down to here, right? At say 410, that's my target. Then I'm gonna sell a put option at this level. Okay, so why sell a put option? Because when I sell a put option, I collect money. I collect a premium, okay? So I collect money over here. And this premium I collect can be used to pay or finance that put option which I buy. So that lowers the cost of my trade. At the same time, it reduces the effect of the time decay, because when you sell a put and time passes, you're making money. When you buy a put, time passes, you're losing money. So they kind of like net square off each other, okay? So I'm gonna show you how I do this right now, okay? Now, some people ask me, Adam, when you're shorting the market, you know, what's the time duration you're shorting? Is it like a week, a month? Now, it depends. There are a few ways you can do it. I'm gonna show you a few ways. So the first approach I'm gonna use is a very short-term approach, where I'm just gonna short the market from here all the way to here. So it's from here, it's like 422, right? 422, all the way down to 410. So I'm just shorting it for about roughly about a 12-point move. So in that case, what I'm gonna do is this. I'm gonna go to my trade tab over here on the Thinkorswim. Now, if I'm looking for a 12-point move, what I do is I look at the right column. Now, can you see this is a 13-point move? This is a 14-point move. So if I'm looking at 12-point move, I just look at this one over here, because 13 points is more than 12 points, right? And this will take 17 days. Okay, so you can see that the software will show you that for the market to drop by 13 points, it will take 17 days. This is based on the current volatility. Now, if you think the market is going to drop 20 points, right? You're betting on a 20-point drop or 19-point drop, then it's going to take 27 days. So the duration depends on how much you think the market is going to move. Okay, so in my case, I'm looking for a 12-point drop initially. So I'm going to trade the options that expire in 17 days, which is the 6th September expiry. So what I'm going to do is I'm going to open this up. Boom, right? Open that up. And I have to first go to put options. So put options are over here. And I'm going to select the strike price. So the current market price is 422. So I'm going to buy a put right at 422, slightly below that. So what's close to 422.14? 422. So I could buy the 422 puts or the 421, doesn't matter, right? So let's say I buy the, okay, tell you what, I'm going to buy the 421s because it's slightly out of the money, right? So I'm going to buy this put, 421. And how much would it cost me to buy the put? The market price, right now the market is closed, by the way. Okay, when the market opens on Monday, the prices will change slightly. So if I'm going to enter the trade on Monday, I have to watch the market price on Monday. So this is only for demonstration because the prices will change when the market opens. Okay, so if I buy this put, it's going to cost me $5.59 per share. Now, one contract of options is 100 shares. So you have to multiply by 100. So you multiply by 100 to buy this one contract is going to cost $559, which is expensive, right? Okay. Now, but I'm going to sell the 410 put, right? Because I anticipate that the market is going to drop to 410. So again, I'm going to buy the 421 and pay $5.59, but I'm going to sell the 410 put. And by selling this put, I collect money, right? I collect $243. And this helps to pay for half of that put option, right? Finances half of the put option, which is not a bad deal. So again, I'm going to write this down. I'm going to buy the 421 put and pay this money. And I'm going to sell the 410 put and collect this money, and I'm going to pay the difference. So the way I set it up is this. I'm going to click on 421. Oops. Do a right click, and I'm going to buy a vertical spread. Boom. There we are. Okay. So there we are. I'm going to buy the 421 and sell the 410. I'm going to select 410 over here. Okay. So what's my net cost of the trade, or my net risk, right? It's $3.16. So times 100 is $316 of entering this trade. So you can see that if I were to click send over here, confirm and send my order in, yep, what's my maximum loss? My maximum loss, if the market goes up instead, doesn't go down, then I lose $316. But if the market goes down to 310, I will make a maximum profit of $784. So is that a good trade? Not bad, right? So I'm risking 316 to make 784. So basically my risk to reward ratio is risking $1 to make $2.40. So as a trader, you can't win all the time. I've said this many times. So even if you have a win rate of 50%, you're right half the time, but if you are wrong, you lose $1, and when you're right, you make $2 or $2.40, you're going to be very profitable as a trader. It's all about the risk to reward ratio. Now again, it's up to me how many contracts I want to trade. If I want to trade 2 contracts, 3 contracts, if I trade 10 contracts, for example, you can see that I'm risking $3,000 to make $7,800. So you size the position based on how big your account is. Now I just entered this trade, by the way, yesterday, and I announced it to my members in my Telegram chat group. I'll show it to you right here. There we are. All right. So this was 19th of August, which was yesterday. And I posted a chart. I said, okay, we have hit that resistance. Looks like we're pulling back to at least this support level. So I'm entering the trade over here. And you can see that I posted my trade, but mine was slightly different because the market was a bit higher at the time. So I bought the 422 puts, I sold the 410 puts, and I entered 5 contracts to start off with. Now, if the market continues going down on Monday or Tuesday, I may add more contracts so I get a bigger position. As the market crashes, I'll make even more money. And then the good thing is that with this profit I make, I can then use the profits to buy more shares of my favorite companies. So when it goes up, I eventually will build my account even more. So that's the whole idea. So again, you can see that for this trade, all I need is for the market to drop from the current level at 421 all the way down to 410, which is this area of support. If it just drops there within the next week, then I can double my money on the trade. Now, what if I'm looking at a deeper pullback? I think, hey, you know what? I think the market could go all the way down to the 50 moving average. Then you could set up the trade for a longer spread, for example, right? So if you're thinking, okay, the market, I think is going to go down to, say, for example, 395, okay? How would you set the trade up? So essentially, if you want to set the trade up, so you would buy, same thing, the 421, but now you want to sell the 395. So it's a larger drop that you are trading, right? So you could do that, 421 minus 395. So in this case, you're looking for a 26-point drop. So you could take a longer, slightly longer term duration. So let's see how that would look, right? Okay, so in this case, what I'll do is, now to move 26 points, how long will it take based on current volatility? So you can see over here, to move 26 points is going to take about 41 days, right? 41 days to move 25 points, which is a bit less than 26. So you could also take the 62 days, but that's a bit too long. 62 days, like 2 months, right? So I'll take the 41 days, which expires on the 30th of September. So I'm going to open it up, okay? And I'm going to set up the trade, buy 421, sell 395. So buy 421, I'm going to buy the 421 and sell the 395. Okay, so more expensive, right? Because why more expensive? You're looking for a bigger drop. The trade's going to cost more. You're getting more time to expiration. So in this case, the trade will cost $700 per contract. But how much money could I make if it drops to 395? Let's check it out. Okay, so you can see my maximum loss. If the market goes up, doesn't go down, I could lose up to $700. But if the market goes down, I'll make about $1,800, which is about 2 times, well, again, slightly more than 2 times my risk, right? So 1892 divided by 708. Yeah, about 2.67, right? So I'm risking $1 to make $2.60. So the risk to reward is slightly better than my initial trade, but I do prefer my initial trade because it's a lower cost per trade. Now, by the way, very important disclaimer, do not trade options unless you're trained in options properly. So you got to take our options trading course or someone else's options trading course, whatever, but you have to learn, you know, all the different methods to close the trade, to manage the trade. You got to understand about the theta, about the delta, about the vega, and all the different Greeks in order to really execute these trades really well. So this is, again, I'm sharing this for educational purposes, but you have to learn everything about options to trade this safely and consistently. So for example, let me just show you what this trade looks like. If I were to open up the profit and loss chart on the trade, you can see what it looks like over here. Okay, cool. So the current price of the SPY is 421, right? And we are anticipating that the SPY is gonna pull back, it's gonna drop. Woo! Right? So you can see that as it drops down, I make money. So this green line is my profit and loss at expiration, which means this options expire on the 30th of September in about 40 days or 41 days, something like that, right? So when the market drops, you can see that I will make the maximum profit of about $1,800, right, at expiration. So I have to wait for the options to expire to get the maximum profit. Okay, so the purple line is the profit and loss on this day. Now, on Monday, it's going to be the 22nd of August. So I'm going to put 22nd August, right? You can see as time passes, what happens here? 22nd August, 23rd August, 24th August. Now, as time passes, notice what happens to the purple line. The purple line starts to move towards the green line. Can you see? So in other words, as time passes, and if the market drops, you will get the maximum profit only near the expiration or at the expiration. So when it's far from the expiration, you don't get the maximum profit yet. You got to understand that, right? But the good news is, by the same token, if the market goes up instead of going down, will I lose my maximum profit, maximum loss immediately? No, I won't, right? Why? Let me just show it to you right here, right? So let's say I enter the trade at 421 and the market starts going up, doesn't go down, right? So if the market goes up to, let's say, 440, how much do I lose? I won't lose the $700. No, I will only lose the purple line, which is about $410. You look at this box over here, you can see the purple line is 410, right? So I'm only losing half of my maximum loss. So the good thing about using options is that if the market goes up, I don't lose everything immediately, right? If I get out early, way before the options expire, I'll only lose half of the maximum loss, which is even better still. So again, in the options trading course, you're going to learn how to manage these trades and how to get out early if it is a losing trade. You can see that I can only suffer the maximum loss only when the purple line drops to the green line, which is the maximum loss. And that only happens if I wait and I hold the down trade all the way to expiration in 40 days. You can see in 40 days, the purple line will drop to the green line. But if I get out in 10 days or get out in 20 days, then I'm not even going to lose $700. I'm going to only lose like $300, right? And in that earlier trade, which I took, I'm only risking $300. So if I exit early, I'll only lose like $150. So with options, the great news is that you can minimize your risk, but maximize your returns. Now, again, this is just one way to profit from the market pulling back. Another way, which I love, and I'm going to use it pretty soon, is to trade options on the VIX or the Volatility Index. So if you look at the VIX over here, VIX. Now, the VIX is also known as the Fear Index, and the VIX tends to move opposite of the market. So when the market goes up, right, market goes up, the VIX drops. But when the market goes down, the market crashes, the VIX goes up. So recently, the market has been going up, right? Ever since June, it's going up. And so the VIX has been going down. And right now, the VIX has hit a support level at $19.78. So if I anticipate the market is going to crash, what do? I go long on the VIX. I buy the VIX in order to catch the bounce. Now, here's the thing. You can't buy the VIX. It can't be bought, right? You can only buy options on the VIX futures. So these are things that, again, we cover in the options trading course. And there are two ways that you can trade the VIX futures. One is you buy a bull call spread, or you can use what is known as a back ratio spread. So in summary, I do hope this has been useful. And in summary, what I want to say is that, remember, that we have no control over where the market is going to go in the short term. We have got no clue. We can just make guesses. But if you buy the index, you hold good companies, it will always go up in a long run, right? But in the short term, anything can happen. So it's good to equip yourself with all the different skills and strategies so that whether the market goes up or goes down in the short term, we can find a way to make money from the markets in order to grow our wealth. And that's the hallmark of a great trader and a great investor. Hope you enjoyed this. This is Adam Khoo, and may the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.